thank you everyone for joining this webinar from the SETsquared partnership. My name is Marty Reid. I'm the Interim Exec Director of the partnership, and hopefully you're here to join a session around managing financial risk for growing tech businesses. Our idea for hosting this session, and particularly to opening up to a wider audience, was precipitated by the collapse of Silicon Valley Bank in the US and in the UK a few weeks back. I think it's fair to say that event and situation sent real shockwaves through the startup tech communities and wider business and banking worlds in general. Particularly the speed at which the situation unfolded and escalated caught lots of parts of the market out, lots of individuals from investment communities to finance communities, and particularly founders or directors of startup and scale-up companies alike of all different sizes. I think for the businesses affected, particularly those that could be really well capitalized, perhaps weren't worrying about their cash, but were pre-revenue, were particularly affected in an area of their business operations, the management of their cash, which they thought was an area they probably didn't need to worry about. That was secure and reliable, when they're focused on growing their company, all of a sudden carried a lot more risk than they'd perhaps previously saw. From a personal perspective, I had a number of founders that I'd worked with ringing up on Friday night, Saturday night, worried about their company existing on Monday or Tuesday, for a variety of reasons, depending on where their cash was held and ended up. So, well, happily, there was a really swift resolution in that case, where from Support UK Gov, HSBC stepping in. It highlighted that an awful lot of businesses, a lot of founders, even if they've been really well supported and are running great companies, could do with a bit more extra thinking on where risk may be lying in how they manage their cash, and particularly what options they should understand or have available to have better access to finance, better management of cash, better manage these kind of risks overall. So we've pulled together a really great panel for you today to have a bit of an open discussion around this. The way this is going to go, we've got some prepared topics that we think have come up, either from questions that many of you submitted in advance, or that came in from the wider community of startups and companies we work with during and immediately after that weekend of uncertainty. But we will call our formal proceedings at a point, probably in around half an hour's time. So we've got plenty of opportunity for you to share questions, either that you've got on your minds at the moment or that come up during the course of discussions. We'll give a little flag probably about 5 minutes in advance of that to let you submit those into the chat, and Karina will support us in managing these and asking these into the panel. So without further ado, I'm delighted to introduce our panel for you today, and I'll just go around and give them a little opportunity to introduce themselves. And it'd be wonderful if, as you introduce yourselves, you could perhaps share a bit of a reflection on not where you were on that weekend, but what really jumped out for you from your professional experience, your connections, as the Silicon Valley Bank situation unfolded, and why this kind of webinar engagement is important to you. So first, I'm delighted to introduce Suzanne Jones.
Hello, good morning. So I'm an insolvency lawyer, corporate restructuring. A lot of my work, I advise boards of directors on their options when they're in difficulties. But also what I see is not only when they're in difficulties, but it's really important to get the structuring right at the outset to protect. And as you mentioned earlier, in the event something happens, if you get your structuring right at the outset, you can deal with these risks that come along. So most of my work involves advising boards of directors.
That's great. Thank you, Suzanne. And if I can bring Louis onto the virtual stage.
Yeah, morning, Marty. Hello, everyone. Louis Spencer. I'm a senior relationship manager here at NatWest Bank in Bristol. I look after and I'm responsible for NatWest Commercial Bank's technology, media, and telecoms clients in the west of England. So that bucket of customers spans startups, scale-ups, various ownership sort of structures, venture capital backed, private equity backed, owner managed, and through into sort of more mid-sized corporates as well, really. So there's a real big mix of customers. That weekend was actually just surreal, Marty, to answer your question. I don't, everyone must be on Twitter, but I'm an avid read. I'm one of those that lurks in the background really and reads everyone else's tweets. And I was avidly sort of hooked onto Twitter, and I just absolutely aghast really at how quickly everything unfolded. And what is and it was characterized as a very classic bank run, but basically unfurling on Twitter in real time was just something that I don't, hopefully we never see again. And it was just, pure shock, really. So we like yourself, I think we were very busy receiving calls around, do we have a plan B available? And I think as a bank, we were particularly sort of quickly engaged with the FCA as SVB's UK agency clearer in the UK. I think we were sort of before HSBC stepped up and, delivered a fantastic outcome for everyone really in the innovation economy. I think we were working sort of pretty hard to deliver a streamlined onboarding process. So for those businesses that needed clearing facilities on Monday morning, it would be a case of us being able to hit a button. Thankfully, we didn't have to sort of get that live really. But surreal really in one word, bizarre.
Yeah, thanks, Louis. And I'm glad you mentioned that, do we have a plan B? I think that theme of a plan B or alternative plans around finances is definitely a theme we're going to come on to. And finally, I'd like to ask Ian to join us on the stage.
Hi, everyone. My name is Ian Matthews. I'm a partner at Moore Kingston Smith. We are a top firm of accountants and business advisors. I predominantly work with tech businesses, anything from startups, scale up, exit, second startup, and beyond. When the feature which really struck me about the SVB was very much the speed it all unfell and on social media, really accelerating that. I was actually in India at the time on a tech delegation, going to dinner with business owners of decent scale-up businesses who could not access their bank accounts and had their payroll to pay that Monday following. They were panicked. There was a sense of resignation and a lot of drinking of woes as well, parts of it. But a lot of people getting in touch about how are we going to pay. I've got these big payment dates going on. Luckily, a lot of them had investment rounds going on at the time, but which were ready to land. But it was squeaky bum time, really, to put it bluntly.
Thanks. Yeah, thanks, Ian. And I think that's that sentiment shared by quite a few. I had some personal contacts that, we're looking at the dates of payroll on the Monday, or a particularly extreme case of one founder that I know personally had started the process of moving the money, their investment money were going into the SVB as a clearing bank as it was unfolding, and felt like they had that loss of control all of a sudden. So I think that panic, that lack of control, which they would normally want or trust, was falling away. Great. Well, welcome. Thank you for joining and sharing your time. And I'll move on to our first area of question. We thought we'd start with some practicalities, and this is really steered by probably the most common question or theme we've had, and from our members, other members of the community, and indeed from some participants today, which is about the management of cash holdings. Startup or scale up businesses are in that odd position sometimes, particularly if they're pre-revenue, where they may have raised investment, maybe be quite well capitalized by any other markets factors, but have to hold that cash somewhere. So we've had questions like, should we be now holding it across multiple locations? What's really safe? A lot of founders felt like they had all eggs in one basket with one financial institution, but just weren't sure if it was worth pursuing alternative arrangements. So I was wondering if the panel could offer some advice on that, where to look, some top tips. I'll probably come to yourself first, Louis, to kick us off.
Yeah, I mean, so in short, the answer to should or could businesses explore that, given the backdrop to this, is yes. I think I don't know sort of the particular size and scale of the businesses and the entrepreneurs in the audience, Marty, but certainly in sort of an SME space, in a mid-market space, it's very common for businesses to have, if they're not formal clearing relationships with accounts open, it's very common for them to have, at least another banking relationship where they are engaged with, people at other institutions. And I think historically that's always been driven by making sure that, your incumbent bank is delivering you, good service, good quality for money, dependent on your view and need of a bank. Sometimes that's driven around sector expertise and your ability to be supported by your bank through that sort of lens, and that's always been the case. I think that there's nothing to stop startups and scale ups taking the same approach, really. And I think many people would probably endorse that sort of engagement now with at least one other bank. And I think just to go back to the point around a plan B, and I guess some of the engagement that we've seen from businesses and management teams, that the catalyst that SVB calls around what's our plan B, and some of the reasons we've been engaged, and something maybe for some of your audience to think about in terms of a plan B in other scenarios, and why might you need other banking. So just to give you an example, so aside from bank failures, we've had people engage with us on we've got a digital only or a sort of a neobank type relationship only right here and now. What happens if we can't sort of access via those channels? We've had businesses come to us to say we've had just, I guess, more broad-based operational issues around getting access to someone, and a bank's cost to serve model is probably prohibiting a good relationship and access to the right support. We've had engagements around ring fencing. That's back in vogue now. So how wide or narrow is a ring fence, and are you protected by FSCS sort of regulation? So all of those scenarios actually will, in one way or another, sort of provoke that what is a plan B if something happens in those scenarios, really. And so I would absolutely endorse everyone to consider, I guess, what type of banking relationships they've got here and now, the pros and cons of it, and actually, if there are if there are chinks in the armor, or that you've got questions around resilience or accessing support that you need in the broadest possible sense, it probably is worthwhile considering just thinking about what you might do to plug the gaps through a risk lens, really. So yeah.
Right. Thanks, Louis. And Ian or Suzanne, is there anything you'd like to add on that?
I think Louis covered it off there. And actually, one thing I would say that Louis said, and when I'm advising boards, we do this a lot, is we always have a plan B and a plan C, because you just, things move very quickly, and you just need to protect yourself in the event something happens. And so we're always looking at plan A, B, C, D. So that's always a good thing, in the board meetings, to look at, if this happens, what do you do? If this happens, what do you do?
Yeah, I think that's good advice in general. Ian, did you want to come in there?
I'd certainly build on that as well. I think scenario planning is key in a lot of businesses, whatever size there is. This is a particular scenario, a situation we've gone through, but you go back only a few years ago and COVID, where actually people were taking their business down and really stripping it down to its bare basics and playing with those scenarios and their cash flow. And some good habits were taken from that. We should be looking at cash flow forecasts. We should be managing our cash, looking at risks to the business. Might not always be appropriate to get a full-blown risk register, but to have a list, have that concept of actually these are the risks to my business and these are the mitigations. And cash flow for startups and scale-ups are generally going to be up there. And then not just looking at that risk and actually figuring out what they're going to do with it, but actually it's that what if question. Is actually, well, what happens if that investment gets delayed 2 months? What if it gets delayed further? It's looking at that sensitivity around it and actually getting a full idea of how that fits into your larger strategy for growth and hopefully a sale.
Great. And I think we'll definitely come back onto that, that question or that issue of investments being delayed. I mean, we've seen that it happens all the time, right? I think we all probably say with all the members and companies to believe a firm date for a deal going through is a bit of a fool's game at times. But I guess in the reaction in this current uncertainty from the SVB situation, we have seen deals moving back right now, even though this immediate crisis was resolved. On that plan B, one area that companies we worked with raised with some urgency, I guess, over that weekend, but then have followed up since, was understanding options around access to debt facilities or debt finance, not necessarily debt finance in terms of the as an alternative to a large investment, but actually access to facility in a cash crunch situation. And I actually found it striking how few had looked at those. And, there was worries that they may end up with very bad short-term deals. But do you have any the panels have any either experience in that area, or is there a place that businesses should be going to look, or how they could prepare to have access to that kind of thing? Suzanne, would you like to?
Yes, of course. Actually, I was advising a board not so long ago, and a very good company, very successful company. And what happened was it was commodity trading, and it was just following the pandemic, and the shipping costs increased, everything was delayed. And it had two facilities with two different banks. And just by pure coincidence, the bank said, we don't want to do this anymore. So this was a really good business. And they just pulled these two facilities. And so it was technically insolvent. And so we were considering all options. And one thing I actually learned in this is when you're looking for, new facilities, be careful how you approach it. Be careful which lenders you approach, because it becomes a bit of market gossip that this is going on. And you have to be really careful how you deal with it. And what I learned in that was you can find specialists like consultants, brokers, whatever you want to call them, who can help you with this. So they can do the discrete inquiries, applications on behalf of the company without the company's reputation being damaged, because it was a good company and we were successful. But I certainly learned that. But that's just a prime example of sometimes you can prepare, for all sorts of things happening. But in this case, who would have thought that was going to happen?
Thanks. Ian, Lou, would you like to add to that?
Yeah, I'll just add on a bit to that. So there's finance available around, and it's having more than one, not just from two providers of the current accounts and the treasury facilities, but actually debt finance. I think that's a common feature to most of my businesses. Generally, they'll be asset-based, though, to have that security against it. Pre-revenue tech businesses will struggle slightly more for that. And actually, I know that's quite to go for debt finance in the first place is something they probably haven't considered because they're having to service the debt. But actually, it's something they should look at, really, because if they've got faith in their model and they think there's going to be revenue generating from it, then actually debt finance might be the route to in the short to medium term.
Yeah, I'll just. It's a tricky one, isn't it? I guess against the context of what we're talking about with SVB, probably deepest sympathies with most people that quickly found out that it was nigh on impossible really to access emergency liquidity really in that scenario. And so I think it does play into the importance of it's a Groundhog Day now, isn't it, having that plan B sort of in place and proactively sort of thought about at the front end. It's an area for us actually, I would suggest that other high street lenders are in the same position, but it's something that as a bank we've really thought hard about and challenged ourselves around how do we support those businesses with in case of need facilities that eminently displaying equity risk characteristics, but actually need some form of in case of need liquidity sat in behind a big equity cornerstone. And it's something that we've written a handful of those types of facilities that based on a really good understanding of business model, strategy, management team, but also just having a really solid sort of equity cornerstone in there, we're able to put in place relatively modest facilities on an in case of need basis, i.e. can we cover payroll for a week, that would allow our I guess the building relationships and underlining the importance of having your bank upside you, so to speak, from a strategy perspective, from a business model perspective, and just having a bit of a roadmap and a story to tell with your bank can go a bit quite a long way in that context. So it's just something to consider, I would say.
Great. I think that's a great way to round that off, that bringing a few of those themes together, that when businesses are doing their business planning, even if plan A is for a large investment round, that their risk management or their risk management and plan B or C behind that, understanding that as much as you can, and then building relationships over time with providers to be able to see what options are available rather than attempting to do it in the short term when I guess a provider would see more risk for them and would struggle to do it. Yeah. If I move on to a slightly different theme then, and maybe we're broadening out this discussion around, we've covered plan Bs, plan Cs, and perhaps, Suzanne, I was hoping to ask you something in this area. Obviously, you have extensive experience of giving advice and engaging with directors of businesses of all sizes, and you've got particularly broad expertise in that restructuring space, insolvency space. I was just wondering, is there any kind of insights or themes you've picked up from when you're meeting those businesses downstream, that as after those challenges have emerged, that perhaps early stage businesses could learn from? What are a key one or two things to kick us off that they should be looking for when they're building their business plan, building the risk register management process?
Yeah, well, what I often say is, because I try to avoid using the word that I'm an insolvency lawyer, because people always think that's very doom and gloom. And I think, insolvency experts can add quite a lot. And how I generally explain this is it's identifying opportunities, but minimizing risk. And I think all the way through, when you're considering, because, the board should be considering the financial position at all times, but considering what the potential risks are to the company. And somebody mentioned earlier on about putting all the eggs in one basket. And this is something I would say that I've seen a lot of companies get into trouble because they have done exactly this. And it doesn't matter what it is in relation to, but it could be, it just has one customer, for example. And it's just that, putting all the eggs in one basket, putting all their money in one bank. They could have two banks. So it's just minimizing those risks, and all the time thinking about, one, identifying what the possible risks are, and then how do you minimize those risks in the event something happens.
But thanks. And Ian, would you like to come in there? I guess you work and engage and offer quite broad advice to a lot of different businesses. What are the key things you're always trying to get home as starting points in business plans for risk, particularly risk around finances?
I always go to the end point. Ultimately, we're dealing with startup and scale ups who are looking to exit. So they're looking to sell on, and actually, if they're not looking at the risks, potential buyers are. So you've got an EBITDA and a multiple you might be going, or some sort of value. The buyers, the sole purpose of the buyer is to, and their advisors, to whittle down that price they're willing to pay you. So if they look at these risks and go, actually, that they haven't got a treasury policy, or that they only have that one sales contract that Suzanne mentioned, or that actually the sales department is the owner. If they exit, we haven't got a business. That's a common issue that I've come across, is actually the founder is the business. You're trying to create something fresh, a product a business that you can sell. So it's trying to look at that exit and then draw and then working backwards from that and going, well, actually, short-term strategy, long-term strategy, objectives. What's the KPIs which will drive that? What the sectors I work in? What markets? So we talk about having more than one cash bank account, but actually, what markets do you operate in? What currencies? What risks are you mitigating against that? What are you billing in? It all fits in. And actually, and into the bigger picture, and then it comes to the point of, well, how are you monitoring this? How often are you checking against this? And ultimately, against that key goal of, I'm trying to sell my business. So how does it help towards that? I mentioned it earlier. It's in this situation, it's managing your cash. So cash flow forecasts. We always recommend that you have a rolling 16-17 month cash flow at minimum, because you know where it's going to go. And at moments of pure stress, which a lot of businesses coming out of the SVB issue was, actually you should be doing a 7-8 week cash flow forecast, actually really getting to grips and understanding what are you going to do with your money, and where's the money coming from, and how you're going to spend it. I don't want to be a broken record, but how you can get that money to get to maximize your return on investment.
Right, I think that's a great point.
Ian's stolen my thunder, actually. So I whilst I've never worked in our restructuring sort of division, to be fair, but I know the gold standard of cash flow monitoring that they will quickly implement into businesses that don't have a handle on cash is a 13 week cash flow forecast, which is updated weekly on a rolling basis. And whilst that doesn't have to be granular to utility bills, but understanding key revenue drivers of cash and key cost drivers of cash, and I guess having an understanding of, I've got my arm up here, but there's a management case, and if you outperform, it's what impact, outperforming from a revenue perspective can sometimes mean less cash, if your working capital cycle is dictating that, and what the downside is as well. And so you would it's surprising that clearly, we wouldn't sit here as advisors and pretend to know businesses better than their owners. But it is also surprising the amount of times that you come into contact with a business that wouldn't understand the impact of something happening in their business on cash in the short term. And, if you're in a bit of a tight spot, or your back's against the wall, how quickly that can, become a crisis, really, and not just a bit of a cash flow pinch, really. So yeah, understanding, sort of continually looking at cash on a short-term cycle is super important.
And actually, quite a lot of the startup businesses that we work with on here are, their income, because of the investment or grants or R&D, are quite lumpy. And they become quite dependent on that as well, ultimately. So it's that runway of an investment round. It's really important to understand how quickly that's going and what your expectations were and how it's actually performing against that.
And one area that we had a couple of questions submitted, actually, was in there for those businesses who are revenue generating. And a common query that comes up and a common issue we've seen that have hit the smaller companies, perhaps with less experienced vendors at times, is getting themselves in a bit of a pickle over payment terms. So those that are generating revenue, and often with impact, quite a lot of impact-led founders, and I know not everyone's in that space, are kind of signed up from day one and doing the right thing. So, they will pay out in the way they want to be paid themselves, but then might end up in a place with some larger suppliers who can be a bit tougher with them. Just wondering if there's any advice, and this is perhaps one for you, first in your kind of broader advisory role, on any guidance or thoughts for SMEs in trying to set up policies around payment terms when they're still trying to be ethical and right, but need to protect themselves maybe as well.
So cash is king is a phrase which gets bandied around quite a lot, but it's true. So being upfront and transparent, though, about what your terms are, depending on your circumstances, is key. So if you're working with the likes of Tesco, who have improved over the years, but who are historically poor payers, you're looking at 120 days. You might have suppliers who are 30 days, 60 days. It's about maybe trying to eke that out a little bit so it matches it. Not always possible. And then if you are able to, and it fits in with your cash flow and your budgeting, pay them earlier. Be that ethical supplier that you may want, you're aiming towards, but it has to be managed within the context of your revenue streams a lot of the time. When COVID happened, our number one piece of advice was, identify your key suppliers who you want to keep on site and who, if they go bust, will have an impact on you ultimately. And make sure you really work the cash and the credit control from your income. But probably the one supplier that you should probably look at not paying as quickly is probably the revenue. That was probably easier a few years ago when the late payment interest rates weren't as high as they are now. They are going up, but actually Taxman's probably one of the people I'd pay last, despite the powers that they have and some of the preferred creditor status changes they had. But that's I'm edging onto Suzanne's territory there.
Yeah, I've had some interesting things. We always say that, leave the taxman till the end, as it were. But interestingly, I have had a case where the taxman, it was quite a high profile company, and the taxman was totally on top of it. I remember in this one, we even got a letter the day before the VAT was due, basically saying, "Oh, you will pay tomorrow, and if you don't pay tomorrow, we're coming in." And I mean, I've never seen, that's the only time in the whole of my career I've seen that. But generally, yes, the taxman to the bottom. The other thing I would say is also make sure you chase sums that are due. And one thing that I have seen a lot is, it could be a well-known company. And they think, oh, well, they will pay. There's just a problem here, there, or wherever. But if they're not paying, there is a potential problem, and just be alert to that and just keep chasing, because if you put the pressure on, you can get some money out. And I had to do that. Actually, I was advising a board, and it was Topshop that owed them a lot of money. And we really put the pressure on, and they were saying, oh, but they'll pay eventually. And you think, oh, well, these kind of companies, they'll never go bust. Well, as everybody knows, Topshop did go bust, and they could have been a creditor for, I think the sum at that time was about £15 million. But because we put the pressure on, we managed to get some money out. And so don't ever be afraid to ask people, who owe money to pay.
Yeah. And we'd agree with that. Even, from my own experience in the world of effectively running accelerators and programs is often like running an odd-shaped SME. But even ourselves are running innovation centres. Putting in a clear, regular credit control process as part of your financial cycle can actually just be quite straightforward. And it's one of those things that maybe to founders and others might seem complicated at first, but just having a register and having that diligence to chase people, it's amazing how quickly and how much cash you can get in much faster. and it doesn't, our experience was it doesn't necessarily need to be a member of the finance team that's doing the chasing, as long as someone with a good operational head to them has got the data and the info to hand, and just that bit of rigor in chasing can make a big difference. So I guess we've spoken a bit about this kind of advice, and Suzanne, you mentioned boards considering risks, and we mentioned earlier around advisors. For those perhaps earlier stage businesses who may not have a full board yet, maybe thinking about appointments, considering advisors, mentors, possibly chairs. I'm just wondering from across the panel, and please, this isn't a push for you to feel like you have to push your own services and organizations. Don't feel worried on that. But where do you recommend that those early stage companies go for that kind of expert advice? Or indeed, whether that's independent advice or whether they're starting on the path to finding mentors or board advisors. So that's quite a broad and open question. So I'm happy for anybody to kick off. But actually, since you've spoken up last, Louis, I might pick on you first. Where would you point kind of businesses to go and recommend? And please don't feel like you have to say go and join SETsquared as well.
The words out of my mouth, Marty.
No.
No, it's an interesting one. So we, as a bank, we operate our own accelerator, and so I guess we've got some experience of building communities and ecosystems, and almost wraparound business support. And so boards and governance is a small part of that. And I would say what we've learned over the last few years is that whilst we've run those accelerators, and that's evolved as well as a proposition, is that it could be a lonely place for those owner founders, and actually just reaching out to people and almost ferreting around and rattling around and just willing to put yourself out there into local enterprise partnerships. For us in the west of England that are based around here, the West of England Combined Authority and Business West, there's an awful lot of wraparound business support, which I wouldn't say is ignored, but I think there's just a lack of general awareness and education around some of the types of support out there, and leadership and governance for a lot of these business support organizations, whether that be in sort of local authorities or combined authorities or whatever, really, or even private institutions like your own, Marty. I think most people, that if they didn't have the answer themselves, can point you into someone that they might know, and that's exactly something that I would do. It's not something that NatWest would offer in-house, but we know some really good people and are friendly with really good people like SETsquared, for example, that are able to provide some real value around governance, for example. And so that's what we do, really. And I think that thing about not being afraid to just reach out to people and just ask the question, because most people are just pretty, you find that most people are just pretty helpful and friendly, right? Most people will just want to help people. So even if you've got half an idea on it, I would just say try it and give it a go, and you'll find somewhere pretty quickly. So.
Ian or Suzanne, any kind of top tips if a founder's starting to, aside from reaching out to networks or providers, if maybe they're starting to think about bringing in a bit of expertise to a board or a consultancy basis? So where's the best places for an early stage founder to start looking, or what should they look for, I guess?
Well, what I would say is, when I'm advising a board, I always say diversity of thoughts is such a great thing. For me, the more brains you have around the table, all the different perspectives, you throw it all into the middle, you get the best ideas. So if they can find somebody who's willing to do perhaps a non-exec role unpaid, I know some people are willing to do that, and I think there's an organization, I can't remember what it's called now. It's it deals with just non-exec directors. And some people are willing to do it for, without payments. So that's a possibility. again, what Louis said, most people are really helpful. And one thing I would say is when boards are in difficulty, sometimes what they do is put their head in the sand, which the best thing to do is just keep talking to different people saying this has happened. Because also when advising a board, there's so many different ways you can do it. There's not one way that's right. You could get to the same goal doing it in 10 different ways. But it's just what's best in the circumstances, timing, money. There's so many factors that affect how you get to that place you want to get to.
No, I'd agree. And just that's a really good example of we talk about boards and governance, and actually if you're an early stage founder who happens probably to be the sales lead and the finance lead as well, actually, to begin talking about full boards is probably, you're nowhere near sort of unlocking that ability to have a board yet. But just finding someone that you trust with business acumen that you can just, will hold the mirror up to you around some of the decisions you're making, that is in effect what a board would deliver, when you reach size and scale. And so, that could be a real informal arrangement, but deliver some massive value. So yeah, Suzanne's made a really good point there, I would say, on that.
And a lot of startup scale-ups, it's very much they are so focused on actually launching, getting the delivery. They work so much on the business, they never just have that time to step back and actually have time to sit back and actually think about where the business is going. Is it the right direction? They're so focused on the features of what they do and maybe the people management. People don't set up these businesses to become people managers ultimately. And if they're looking for investment, actually, it's not just the money people look for a lot of the time. In my experience, it's actually they're looking for the knowledge, the sector know-how, the people who will actually hold their feet to the fire and push them in the right direction. And again, coming back to getting to that end result and just try and pulling everyone in the same direction. And actually, coming back to one of Louis' points from an earlier point, is that banks do have this knowledge and the expertise, and while a lot of startups will go for online accounts, etc., having a decent relationship manager, especially at points like this, having a person at the end of the phone. COVID again was a classic example of this, where actually you can chew the fat, you can talk about the business, where it's heading, and actually speak to a human being ultimately, and actually get value from that, having that account, and actually that safety net and that security.
Yeah, I agree. Just talking through things, and you can just pick up the phone and just have a conversation with your relationship manager and say, "Oh, I'm thinking about this, that, or the other. What do you recommend?" And then you can call another one, and you can keep having these conversations over and over until you find what is the most suitable thing for you to do.
Great, thanks. So I think that's a really great theme for us to close our own questions on, that reaching out and not being afraid to, and partly with advisors, partly having facilities that will offer that, as well as, and perhaps in combination with easy faceless online things. But also I think an important thing you mentioned, Louis, from the experience of the accelerators, peers as well. I think that's one of the huge, alongside great business support, engagement, training facilities, and so on, that community of peers, and finding peers that are a safe space to ask one another these questions. Fab. So I've gone through all of the questions we'd pre-prepared. So please, an open ask for the audience. If there's anything you would like to ask, Karina is in the chat fielding questions. You can send it direct if you'd like it to be private, or please just to pop it on the public chat there, and we'll pick it up. We have got one in so far, which I'll pick up, and this isn't open for any of the panel who thinks they can best answer this. It was a specific question around that, what could be considered or used as assets or support in debt finance. And I guess that could be either having or preparing a facility or actually raising debt finance. But there was a specific question on can or would IP or patents considered an asset when you're looking to that was a tricky question. Or did I cut out for a sec there, perhaps?
You did cut out for a little bit, Marty. I think we got the rub of that though, around asset-backed funding and IP potentially being used.
Whether IP patents could be used as assets when looking to raise debt finance or look for debt finance facilities.
Yeah. So, broadly speaking, most of the tangible assets that a business might have on a balance sheet, including stock, trade debts, other instruments that are, fairly liquid, a bank or another financing institution could potentially use those assets to unlock funding against them. You'll find that dependent on the nature of the diligence or the amount of work that's required to understand the value of those assets on the balance sheet, but also the written down value of the assets on the balance sheet will normally preclude a de minimis size and scale of facility that someone might put out, in the market, depending on what those assets are. IP is an interesting one actually, and it's one that within NatWest Group we do have a capability to lend against IP assets through Lombard, which is our asset finance division, and so we have a software IP capability where, in the same way that a bank might go and value a bricks and mortar asset and then lend against that, via residential or commercial mortgage. We do now have the capability to effectively mandate a third-party IP specialist to go in, value your code, so to speak, and there's a number of drivers of that. So it's a bit around how critical it is to the business, a bit around sort of market size and opportunity and what that delivers, a bit about, is there a secondary value to that IP that, a funder could spin off in the event of a default, but after all of that, we can actually assign a value to an IP and then lend an amount or an advance an amount up against that. I would add though that is very much still a senior debt solution. So there's still we would still need to evidence affordability and a track record of profitability and cash generation to service that debt, the same way that you would have to do for a traditional term loan. But it just means we're reliant on a different basket of assets in essence. But it does exist. It is out there, Marty. So yeah.
Thanks.
And I've had a client who has actually used that exact facility with Lombard, so I can actually back that up. And it was a long-standing tech business, but yes, that facility is available.
Great. I'm just having a little quick question, maybe a last minute or so. If anyone in the audience would like to raise or ask a question, now is the time to do it. I had one closing question ourselves, which was a little bit of seeing the future, perhaps seeing what's happening right now. With, I guess, uncertainty caused by the SVB situation, but also changing markets anyway. Just wondering if we've seen, are we seeing any changes in either new services, new facilities emerging that are kind of designed or could better service this area of the market that are emerging that we could keep an eye on or be optimistic for in the future?
I've not seen any new services as such, but I do know people are trying to make most of the FCA's protection service, actually trying to really max out the £85,000 by looking at that's under review. Well, that possibly at the moment as well to consider. that I personally haven't seen many services. I think I've just seen a lot more people looking to having multiple bank accounts.
One thing I would say also that I see, some companies now accepting payment and making payment in crypto.
Yeah,
so not using cash.
So the only other thing I would add in there, Marty, around Outlook is I think for some time, and probably over the last 10 years, banks in particular, it's felt like actually there's been a real race and running towards how can you best digitalize processes, right? So you're really moving away from relationship management model, and actually the barrier to unlocking a relationship manager is moving higher and higher. I would assert, actually, given everything that's gone on over the past few weeks around banking, that banks will probably be taking stock on how quickly they do that moving forwards, and potentially even reinvesting in their own cost to serve models and re-expanding where in areas they were probably pulling back. And so one of the areas that we've certainly seen the value of having a model that caters for named person contact in a banking sphere down to relatively small business banking levels has been super valuable to those businesses, just to be able to pick up the phone to someone. And so I would say that that will come under the microscope in the coming years because of what's happened with SVB and Credit Suisse as well. So it's interesting.
And likewise, I'd actually expect that some of the challenger online-only banks will probably go into that market to expand it. And in fact, I know that there was one relatively new one which is starting to do relationship managers from last year, very early stages, but there is value to it. It's why the high street banks have been doing it for so long.
Yeah.
And I don't know, that's a trend that I'm supportive of. That I think that while the digital transformation is fabulous and making things more efficient, it's reassuring that we kind of come back to actually being open to being able to speak to. That's been an absolutely fabulous conversation. In a moment, I will perhaps ask the panel just to share their closing one thought, if they were for audience members to have one takeaway. But I'll fill for 30 seconds so you can have a little quick think about that. And I'll just say a big thank you to all of our attendees who've invested your time in coming to hopefully pick up some useful things. I've put up some key themes together and share this out as a blog, so that that a wider community can maybe get benefit of that. But I just say to thank you so much for Suzanne, Louis, and Ian for taking the time to share your experience with the group. And as is one of those themes that I've gone through, if you are in the position that you're a founder, that you are worried, if you're concerned, please do reach out to the SETsquared team. As Louis said, right, as a really critical point, people working in this world tend to be those that are up for helping and supporting. And if we aren't the right organization, don't have the right answer, I'm sure we'll almost certainly find the right people to help you. So on that note, I'd like to perhaps, I'll go around the panel and ask for a closing thought from each of you you'd like to share. I'll just go around by screen. So Suzanne, would you like to go first?
Yeah, well, I think what I would say is, just keep talking. Don't be afraid to ask any question. No question is a silly question. Just keep talking to different people, get all the different perspectives and figure out the best way to deal with it going forward.
Thank you. And Ian?
Cash flows are an important part of startup and scale up businesses. It would very much looking at towards the end goal. Keep reviewing it with clarity of where you want that, what you want to get out of that cash. Great, thanks. And Louis, you get the closing words.
Oh wow, I'm with Suzanne actually. I would say just reach out to someone if you've got anything on your mind as an owner or a management sort of team. People will help, right? Just do not ever forget that people are just inherently helpful in the tech space in particular. So reach out. I'm 100% confident they will help you.
That's great. That's a great sentiment to end on. So again, thank you to all of our panel and those who have joined us today. And a thank you to Karina and the SETsquared team who work in the background and let this all happen smoothly and just let me come on and talk. So I appreciate all your time and enjoy the weekend when it finally arrives. So thank you all, and we'll see you all again soon.